Today, we're tackling one of the most volatile and frankly stressful situations you can find in the market. We're analyzing a high-profile company whose stock price has been absolutely brutalized. Our mission today is pretty straightforward. We've got a stack of analysis focused entirely on the electric vehicle maker LUCID, that's ticker LCID. We're going to cut through the noise and figure out if this is a classic case of dead money, or if this extreme low actually represents a genuine golden opportunity. And the conflict in the source material is, well, it's immediate. The market is just screaming sell. The fear is obvious. But there's this really strong contrarian argument that says this low valuation completely misses the company's real long-term value.
And that price action is the perfect place to start. As of the analysis, the stock closed at $10.57.
Okay.
That's just cents above its 52-week low of $10.46. So you're looking at a stock that has entered a deep, deep danger zone. The market has priced in a massive amount of risk.
Okay, so let's unpack the fear first. To understand the opportunity, we have to understand why the market is so terrified. What are the main concerns driving this bearish sentiment?
Well, you have to start with the cold, hard financials. And the first thing is just the pure devastation of that price action you mentioned. It's down roughly 70% from its 52-week high of $36.
A 70% drop is just, it's devastating for a stock that was, a high flyer not that long ago.
It is. And that kind of drop signals a huge dissatisfaction with management. But the second, and I'd say most critical concern, is the cash burn.
The cash burn.
The financials are frankly alarming. LUCID is burning close to $1 billion.
$1 billion.
$1 billion per quarter just to operate and scale up production.
$1 billion a quarter. I mean, for perspective, how long can any company sustain that kind of bleed? Especially when growth is slower than they promised.
That's precisely the calculation the market is making. And it leads directly to the third point, margins.
Right.
The margins are still deeply, deeply negative. The latest figures show a net profit margin of negative 290%.
Negative 290%. Okay, explain that to us in simple terms.
It means that for every dollar of revenue they bring in from selling a car, they're spending about $3.90 to produce and sell it.
Wow.
Put simply, every single Lucid Air sedan sold is currently losing a significant amount of money on paper. They are nowhere near profitable.
So if you combine the billion-dollar quarterly burn with negative margins on every car, the fear writes itself. The market is pricing this like bankruptcy is a real risk?
Exactly. The market is betting that the company runs out of fuel before their next big thing, the Gravity SUV, can save them. And, that's a rational fear.
But this is where we pivot. This is the core of the deep dive. Because despite those brutal financials, the source material points to 3 strong arguments for a reversal. Well, let's start with what the analysis calls the ultimate safety net.
This is reason number 1, and it's the most important factor. It's the Saudi put. It's what separates Lucid from every other struggling EV startup.
A put. Tell us what that means in practical terms.
It means that Lucid isn't just viewed as an American car company. It's a strategic asset for the Kingdom of Saudi Arabia.
Okay.
Their sovereign wealth fund, the Public Investment Fund, or PIF, owns the majority of the company.
And the PIF has deep pockets.
The analysis is blunt. The PIF has unlimited pockets relative to what Lucid needs, and they are extremely unlikely to let the company fail. It's just too important to their own strategic vision to diversify their economy.
So if you're buying this stock at $10, you're buying a company that has a level of capital stability that most startups can only dream of.
It changes everything. The analysis argues that the downside, the risk of total failure, is essentially capped by that PIF support. They'll keep funding the burn until the company hits scale.
So that existential risk that hangs over other EV makers isn't really there.
That's the key insight. But it does raise a critical question you have to consider.
Which is?
Doesn't this introduce a different kind of risk? Not market risk, but political or strategic risk. The company's success is tied to the goals of a foreign sovereign entity. That's a layer of complexity here.
That is a crucial counterpoint. You're trading market volatility for geopolitical dependency. Okay, let's move to reason number 2, which is all about getting to scale. The Gravity catalyst. Why is the shift to the Gravity SUV in 2026 so critical for the golden opportunity case?
Because it fixes the market problem they have right now. The Lucid Air is a technological marvel, but high-end luxury sedans are a niche market.
You see it with Tesla, with Porsche, all of them. The volume isn't in sedans.
Exactly. The volume, the real profit, is in the luxury SUV segment. That's where the market is. Gravity is their first real attempt to capture that volume. It's their Model Y moment.
And the analysis argues this pivot unlocks the whole value proposition.
Absolutely. The potential is huge. If Gravity captures even a small fraction of the luxury SUV market, their last quarterly revenue of around $336 million could, double or triple pretty quickly after launch.
But the market's just ignoring that right now.
It's completely ignoring it. It's fixated on the current low sales and the cash burn. It's not pricing in the 2026 growth potential at all.
So how does Gravity fix that massive negative 290% margin we talked about?
That's the path to profitability. The
Yeah.
negative margin isn't just about high material costs, it's about low volume. You have this massive multi-billion-dollar factory in Arizona.
And you're not using it efficiently.
Not at all. Your fixed costs are spread over very few cars. That's the definition of lacking economies of scale.
Right.
Gravity allows them to dramatically increase utilization. When they're making tens of thousands of SUVs, those fixed costs get absorbed and the cost per unit plummets. That's how you get to positive gross margins.
That's a compelling future. Let's get to the third reason for optimism, which is about their core tech. Even with all the struggles, Lucid still has, arguably, the most efficient motors and batteries in the EV market.
It's their crown jewel.
Yeah.
And this is the third major bullish case, the licensing and supplier play. That best-in-class tech is an asset they can sell to others.
And we've already started to see this play out, haven't we?
We have. There's a tangible example. Aston Martin. They signed a big deal to use Lucid's motor and battery tech in their new EVs. It's a huge validation.
So how does that change their valuation? Because this feels like a fundamental shift in the story.
It is. It suggests that at this low valuation, we're talking a market cap of only $3.4 billion, Lucid becomes a really attractive technology source for legacy automakers who are struggling to build their own EV platforms.
They can just buy Lucid's proven tech instead of spending billions on R&D with no guarantee of success.
Precisely. Licensing could transform the company. Instead of being seen as just a car maker, which gets a low valuation multiple, they could be seen as a tech supplier, and tech suppliers command much, much higher multiples.
So it's high margin revenue using research they've already done without all the capital spending of building a whole car.
It's an intellectual property play, and it provides revenue that can help fund the Gravity scale-up. It's a triple threat: sovereign backing, a volume product, and an IP revenue stream.
Now that we've laid out that optimism, let's quickly check the short-term signals. Because even if the long-term is sound, the price right now matters to you, the listener.
On the technical side, the analysis points to a few signals that a bottom might be forming. First is the Relative Strength Index, the RSI.
And in plain English, what does the RSI tell us?
It's a momentum indicator. And right now, it's showing the stock is deeply oversold on the daily chart. Essentially, it's fallen so far, so fast that the selling pressure looks exhausted. It looks due for a bounce.
So the technicals are aligning with that contrarian view.
They seem to be. Second, that price level between $10.40 and $10.50 has become a key support zone. It's like a psychological line in the sand. As long as the price holds above it, that's a constructive sign. And finally, the analysis noted that trading volume really dried up during this last sell-off. High volume on a drop means panic. Low volume or dry volume suggests seller exhaustion. The people who are desperate to get out are probably already gone.
Okay, let's bring it all together. We started with a terrifying financial picture. $1 billion quarterly burn, deep negative margins. But we've countered that with these huge structural anchors. You have the sovereign wealth backing, the pivot to the high-volume Gravity SUV, and this best-in-class tech that's already being licensed out.
The conflict is crystal clear. The current price reflects today's fear over cash burn and execution risk, but the underlying value proposition is tied to state-level strategic backing and proven technological superiority.
So it really comes down to execution, but it's an execution play with the ultimate safety net. Success hinges on a single successful pivot. From niche sedan maker to volume SUV player, backed by massive, patient capital.
That unique capital structure is what allows them to survive these negative margin years that would kill almost any other startup. The risk is all about the timeline.
Which leaves us with one final thought for you to consider. Given the current low market cap of only $3.4 billion, which basically values Lucid as just a struggling assembly line, does the strategic asset value backed by the PIF, holding best-in-class patented tech with the 2026 Gravity launch on the horizon, suggest that the current valuation might be missing the mark on future strategic growth entirely?